Everyone, thanks for tuning in to our May 2026 Investment Committee update. I'm Chad Smith, a managing partner at Reveille Wealth Management, and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Markets continue to rally in May, led by technology and small cap stocks, while most major asset classes remain in long-term uptrends, despite signs of narrowing market participation beneath the surface. The committee expresses concerns over the unprecedented valuations of upcoming IPOs such as SpaceX, OpenAI, and Anthropic, as well as recent Nasdaq rule changes that could quickly add these companies to major indexes. Meanwhile, international and emerging market equities remain among the strongest areas of the market, with emerging markets potentially entering a new long-term bull market. Commodities and REITs continue to provide diversification benefits, though commodities may experience a period of consolidation after strong gains. The bond market remains fragile as investors assess inflation risks and the policy direction of new Federal Reserve Chair Kevin Warsh, leading the committee to favor shorter duration and higher quality income strategies. So I'll now turn it over to Stephen to take us through this month's review.
All right, thank you so much. So I'm joining you for this review from the New York City Athletic Club at the ETP Forum, the Expert Series presented by ETF Global. So happy to be here meeting with other industry professionals, financial advisors, investors, sovereign wealth funds are all here today. So happy to be able to join with you for the May review. So let's get started here. And so at the index level, markets continued to advance in the month of May. Large cap U.S. stocks were up. S&P 500 was up over 4% in May, while the Dow Jones Industrial Average managed maybe about half of that. The small cap Russell 2000 continued its run of outperformance over its U.S. peers. International stocks were also higher, but commodities and bonds both fell in the month of May. Despite the decline in commodity prices, they do remain, however, one of the best performing asset classes in 2026. Now, we have some very large and highly anticipated IPOs coming down the pipe. Now, there are only currently 11 companies in the world that have a market capitalization of over $1 trillion. 9 of those are U.S. listed technology companies that have grown into those valuations over many decades. Alphabet, the parent company of Google, they IPO'd in 2004 at a valuation of $23 billion. So it's hard to fathom that a company like SpaceX, looking to go public with a valuation that's almost 100 times the size Google was when it first came to market. Now, all 3 of these highly anticipated IPOs, SpaceX, Anthropic, and OpenAI, they're all looking to fetch trillion-dollar or near trillion-dollar valuations. What's even harder to reconcile about that is not a single one of these companies currently turns a profit. They're all losing money. So that means that you can't value them on a price to earnings basis. They have no earnings. So you'll have to use price to sales ratios to get a reasonable comparison. And these metrics are really eye-popping. The S&P 500 index is as expensive as it has ever been on a price to sales multiple at around 3.5 times. Now that's skewed higher by the likes of NVIDIA, which trades at 21 times price to sales. Apple is 10 times price to sales. Alphabet, 11 times. Microsoft, 10 times. But get a load of these numbers. SpaceX, at a $2 trillion valuation, would have a price to sales multiple of 107. 107. OpenAI, 36. Anthropic, 24. So absolutely insane valuations, and we've never seen companies that are already that size IPO in the US. Now, Saudi Aramco is a little bit of an outlier here because it was privately owned for many, many years. And while it's one of the world's largest companies, it's not listed in the United States. So I'm kind of skeptical of how the markets are going to function when companies of that size are inserted into the major indexes. More on that here in just a minute. But I want to add one more comment that I find very odd. So Anthropic, they're planning to IPO here in the coming months. But the Wall Street Journal ran an article in the middle of May saying that the company was raising billions of dollars in advance of their IPO. So I read that headline and did a double take. So they ended up raising $65 billion. But why are they raising money from venture capital now if they're planning to raise billions of dollars more in the public markets in just a couple of months? It makes no sense to me, and it actually begs more questions than gives any answers. Now, not only have we never seen companies come to the market at such elevated valuations before, but there are actually new rules that have been written to provide these companies with entry into these major indexes in a very short period of time. So each of these three anticipated IPOs, they're expected to list on the Nasdaq and be included in the Nasdaq 100 index. Formerly, the rules for Nasdaq 100 index inclusion would require that a stock be listed and publicly traded for 3 months before it could get included. Now, that would allow the market time to determine what the company was worth and maybe even consider an earnings report before it was inserted into the index. But they amended those rules. So now 3 months of price discovery has to take place in only 3 weeks or 15 trading days. They also used to require that companies have at least 10% of their company stock be publicly traded to be included. Now, they've removed that threshold entirely, essentially to accommodate SpaceX, which intends to only offer 5% of the company publicly in their IPO. So that actually created a problem for the index. If SpaceX IPOs at a $2 trillion valuation, it's going to be either the fourth or fifth largest company in the Nasdaq 100 index. By extension, it probably would be given about a 5% weighting in the index. And there's approximately $700 billion that is indexed to the Nasdaq 100. That would require the index to buy around $35 billion worth of SpaceX stock after 15 days. And the problem is that would equate to nearly half of the $75 billion in stock that SpaceX plans to issue. So they created this new rule that says we're not going to be a market cap weighted index anymore. We're going to make sure that we're not in a position where we're required as an index to buy a substantial amount of the company's outstanding shares and possibly need to buy more of the stock than is available for sale. So this new rule is going to reduce the amount of stock that the index has to buy if the company has less than a third of its stock publicly traded. So the new 3x float rule says that the company's market cap to be considered within the index is going to be limited to a fraction of its overall size until more than a third of the stock trades publicly. So for example, if SpaceX only has 5% of its stock that's trading publicly in the open market, the Nasdaq 100 index is only going to include 15% or 5% times 3 of its market capitalization. So that means it's only going to be considered a $300 billion company initially, 15% of $2 trillion, which is going to give it maybe an index weighting of around 1.5%, not 5. And it's only going to require the index to purchase $9 billion worth of the stock versus 35. So long story short, retail investors are going to abruptly have these new issues thrust upon them at peak valuations, and the Nasdaq 100 is trying its best to limit the extent that the index itself might be a major bag holder if things go awry. Now let's jump into some charts here. The S&P 500 index, it remains in an uptrend after a reversal off the April lows, new monthly closing highs for the S&P 500. The only problem with those new highs in the S&P 500 index is that it was not enjoyed by all 500 constituents. As a matter of fact, almost 10% of the components within the index traded to new one-year lows. So there has only been one other time in the last 30 years where the index has had such a high percentage of new lows at the index level when the market is trading at new highs, and that was in very early 2000, only months before the market peaked. So what we'd really prefer to see is that market breadth is wide and that most stocks are confirming the direction of the index, and that's not the case today, and it should be a cautionary tale. Let's move on to mid caps. This is still one of the cleaner setups in the market. We've retested those former highs from November 2024 on that pullback in the spring. It's turned into support for right now, still in an uptrend, and as long as we're above those former highs, we should feel comfortable owning mid caps. Small caps, same story, only with a longer base. Those former highs from November 2024 were the same highs that we first saw in October of 2021, which meant that the small cap index made no progress for 5.5 years. The index was able to break above those former highs, pulled back and retested those levels in April. Those levels have held right along that uptrend line. And so as long as we're above those former highs and above this uptrend line, we should be very bullish here for small caps. Developed international stocks also still in an uptrend. When we zoom in, we can see that this index is still just below the highs that it put in at the end of February. So still just below those former highs, right? But it's just kind of coiling right now. And it's got a series of higher lows, but still not breaking above those former highs yet. Now, after such a large advance that this space had from the middle of 2025, it makes sense that the category deserves a breather. It can digest those gains. But if we can get north of those former highs from February, then this multi-month correction that we've been in could be coming to a close and a new leg higher would be on deck. Emerging markets have been incredibly strong. We've talked about how this breakout above those 2007 highs was such a big deal. Got a pullback to that level in March and April from the Iran conflict, but we held at that critical level, and that has led to a structural breakout here in emerging markets, new all-time highs for the index. We're now actually currently only about 6 to 9% away from some areas where we may start to encounter some resistance initially for this area of the market. But understanding that emerging markets are likely in a new structural bull market, we would expect to achieve a number of extension levels for this area, but expecting that we could see some resistance in the near term for emerging markets. Now, commodities, we've been talking about how those former highs from 2022 were likely to result in some resistance, and that appears to be exactly what has taken place. We had been recommending that investors with allocations to this space pare back their exposure as we challenge those former highs. Now, the index has been buoyed higher over the last couple of months by the surge in energy prices, which is about 50% of the commodities index. Precious metals, which had garnered so much attention throughout 2025 and earlier 2026, they've actually fallen a decent amount recently. Gold is down over 20% since late January. Silver's fallen almost 40%. Now, the asset class itself remains in an uptrend, but we should likely anticipate some prolonged digestion here in this category. We did have a little bit of a bearish divergence in momentum on that last attempted breakout. So as long as we remain beneath those 2022 highs, this asset class is probably going to pull back towards this uptrend line here. Best case scenario is that we're just going to continue to be really choppy here for a little while, and that could be a little bit of a headache. So for people who haven't established a position in this asset class yet, you probably want to wait for either some sort of a correction to conclude or be a buyer of a breakout above those 2022 highs, whichever happens first. Now, REITs are in an uptrend, right? We are getting above those highs from 2024. This asset class has been a little bit of a disappointment for a number of years. It's been pretty volatile. It's consistently underperformed the S&P since at least the middle of 2022. But that could be changing here as the technical picture for REITs continues to improve on an absolute basis. Look for them to potentially start to show some relative strength too versus the broader market. Now, the bond market remains in an uptrend, but barely. We've been talking about this one regularly on our weekly YouTube show, The $1 Million Question, if you're not subscribed to that. But in late May, we said that we were potentially needed to be bracing for the bond market to enter a new downtrend, but, right, zoomed in, this is why we always wait for these weekly candles to complete before we make decisions. So the fact that the bond market was able to rally in late May was able to help it maintain its uptrend. And so for now, we can continue to maintain exposure to the bond market, but want to be watching this carefully. Now, inflation expectations are likely to be a big factor in the direction of the bond market. Similar to the commodity chart that we saw earlier, we've been challenging those highs from 2022 in this ratio of Treasury inflation protected securities versus nominal treasuries. So this is a way to gauge the bond market's assessment of inflation. If it's moving up and to the right, then inflationary pressures are likely rising, or the market's anticipation that inflation is going to rise. If it's sideways or falling, then maybe inflation's steady to declining. So we've now got Kevin Warsh, who's being sworn in to lead the Federal Reserve, and he's coming in at a very pivotal time. We believe that the bond market has already priced in that the Fed's likely going to be raising interest rates by a quarter point within the next 12 months. But if a breakout in this ratio happens, then it's probably not a good outcome for bonds, because it's likely going to pretend additional interest rate increases are going to be on the table. So with that, I'm going to hand it back for a recap, and then I'll leave us with some final thoughts.
Thanks, Stephen, for taking us through this month's review. So to recap, global markets rallied in May, led by tech and small caps, though narrowing market participation suggests some underlying fragility. The committee flagged concerns over unprecedented valuations for upcoming IPOs, such as SpaceX, OpenAI, and Anthropic, and new Nasdaq rules that could fast-track them into major indexes. International and emerging markets remain exceptionally strong, with emerging markets potentially entering a new long-term bull market. The bond market remains fragile amid inflation risks and policy uncertainty under new Fed Chair Kevin Warsh. The committee favors shorter duration, high-quality income. Meanwhile, commodities and REITs provide solid diversification benefits. So with that, I'm going to turn it over to Stephen for some final thoughts.
All right, thanks everybody for joining us here for our May review. Appreciate you tuning in. Hope that you're finding this insightful. As always, if you have any questions, feel free to shoot us an email, info@reveillewealth.com. Hope everybody had a wonderful Memorial Day weekend. Hope your summer is off to a great start, and we will look forward to catching up with you here at the end of June. Thanks again, everybody. We'll see you soon. Take care.